Silver just dropped below $65 an ounce. And if you're sitting there wondering whether to panic, buy more, or just close the app and pretend you didn't see the price, stay with me. I'm going to walk you through exactly what's happening, why it's happening, and what the mainstream financial media isn't telling you about this drop. This isn't one of those videos with a scary headline and 20 minutes of rambling. I know from your comments that some market channels just recycle the same 5 sentences every week with a new date. That's not this. Today, we're going deep. New numbers, new context, new angles you haven't heard yet. Grab your coffee, settle in, and let's figure out what's actually going on with silver this week. Hit that subscribe button if you haven't already. I post fresh breakdowns like this multiple times a week. Let's get into it. Here's the simple version first. Silver's been sliding for about a week. It touched the low 60s on Friday, the lowest level in roughly 6 weeks. Weekly drop, close to 5%. Now 5% might not sound dramatic if you watch stocks. But for silver, that's a serious shakeup. Let's add context. At the start of this year, silver broke past $120 an ounce. That's massive when you remember that just a couple years ago, silver traded in the $20 to $30 range. So even after this pullback, silver's still up well over 100% from a year ago. We are not near a collapse. We're talking about a correction within a much bigger bull run. Why did it drop this week? 2 big forces collided. Force 1, the US dollar got stronger. When the dollar strengthens, things priced in dollars, silver, gold, oil, get cheaper. The dollar climbed to its highest level in about a year this past week. That's a big deal. Force 2, the Federal Reserve. The Fed met this week and left rates unchanged. Expected. But here's the twist. The tone was far more hawkish than anyone anticipated. Hawkish means the central bank is leaning toward tightening things up, possibly raising rates. 9 out of 19 Fed committee members now signal at least one more rate hike before year's end. A few months ago, everyone talked about rate cuts, not hikes. Complete shift in tone. The market now prices in roughly a 70% probability of a rate increase by September. Why does this matter for silver? Silver doesn't pay dividends. It doesn't pay interest. And when rates go up, savings accounts and treasury bonds start looking attractive because they pay guaranteed returns. Silver, sitting there with no yield, starts looking less appealing. That's why hawkish Fed talk almost always pressures precious metals. Here's what most channels are glossing over, and I think it's the most important piece. This was Kevin Warsh's very first FOMC meeting as the new Fed chair. First meeting. Every word analyzed by traders, economists, and algorithms within seconds. Everyone knew rates weren't moving. 97% probability of no change. What everyone watched for. The tone. The dot plot. How Warsh handled press conference questions. And here's where it got interesting. Warsh didn't signal rate cuts anytime soon. Instead, he leaned into the inflation story. He pointed out that inflation's been running above the Fed's 2% target for several years. Restoring price stability is still job number 1. Pretty tough stance for your first meeting. Here's the nuance everyone misses. There's a difference between treating inflation as temporary versus structural. Temporary inflation, from short-term shocks like energy spikes, doesn't require aggressive, sustained rate hikes. That's actually bullish for silver. But structural persistent inflation, that opens the door to longer periods of higher rates. That keeps pressure on silver and gold. Right now, Warsh's position is somewhere in between. He didn't fully commit either way. Smart political move for a new Fed chair. But that ambiguity is exactly why silver wobbled instead of crashing or rallying hard. The market hates uncertainty. Let's talk about something that should be pushing silver higher, but oddly isn't. Earlier this year, conflict between the US and Iran sent oil above $100 a barrel. That drove inflation expectations higher for months. This past week, major development. The US and Iran signed an interim agreement to de-escalate conflict, reopen the Strait of Hormuz, and remove some sanctions on Iranian oil exports. On paper, fantastic for the global economy. Oil prices dropped. Stock futures jumped. But here's the strange part. Gold and silver didn't get the same bounce. Why? Because precious metals, investors are looking past the ceasefire headline. They're focused on the lingering inflation that's already baked into the system from months of conflict. Plus, the very real possibility that the Fed will respond to that inflation with higher rates regardless of how the geopolitical situation resolves. The damage from months of war-driven inflation doesn't just disappear when a peace deal gets signed. The metals market understands that better than the stock market does right now. There's also a trust issue. Reports came out that planned follow-up talks between the US and Iran didn't even happen as scheduled. How durable is this peace agreement, really? Seasoned commodity strategists warn traders should be careful chasing headlines on this conflict. We've seen promising news followed by setbacks before. So silver isn't rallying because the market's been burned before. It's waiting for actual follow-through rather than reacting on hope. I want to introduce one of the most underrated tools for understanding where silver might be headed. The gold-silver ratio, never heard of it? Simple explanation coming. The gold-silver ratio tells you how many ounces of silver equal the value of 1 ounce of gold. Right now, about 61.7, roughly 62 ounces of silver equal 1 ounce of gold in value today. Why does this matter? Historically, over 50 years, the average ratio sits between 65 and 70. So even with silver's recent pullback, silver is currently slightly expensive relative to gold compared to the long-term average. But here's where it gets interesting. During strong precious metals, bull markets, that ratio compresses significantly, sometimes dropping to the 40 to 50 range. Why? Because silver, being smaller and more volatile than gold, tends to outperform gold once a rally really gets going. Silver investors call this silver playing catch-up. Think about the math. If gold's trading around $4,344 and the ratio compresses to 60 to 1, that implies a silver price near $72. If the ratio compresses further toward the historic bull market range of 45 to 50, you're looking at considerably higher silver prices, even without gold moving much. Now, ratios are tools, not guarantees. But the trend over the last couple weeks is notable. The ratio moved from around 64 down to 62. That tells you silver's been gaining ground against gold on a relative basis, even while both metals had a rough patch in dollar terms. Here's something buried under all the Fed headlines that might matter more in the long run. Silver has a serious supply problem. It's been building for years. Unlike gold, mined almost entirely for jewelry, investment, and central bank reserves, silver has a split identity. A huge portion of silver demand comes from industrial uses: solar panel manufacturing, electric vehicles, medical devices, electronics, industrial sensors, AI hardware. This means even when investor demand cools off, industrial demand keeps chugging along. Solar panel manufacturers don't care what the Fed says about rates. They need silver to keep production lines running. Here's the kicker. The world's run a silver supply deficit for roughly 6 consecutive years. Global demand has outpaced mining supply for half a decade straight. Above-ground stockpiles have been steadily drawn down. Some analysts, tracking inventory at exchanges like the LBMA and COMEX, have flagged delivery delays and tightness signals. Physical silver is becoming harder to source quickly, even though paper trading continues smoothly. That disconnect between paper markets and physical availability? Stackers should watch this closely. When that gap widens, it tends to create sudden, sharp price moves once the market fully wakes up to the shortage. Major silver-producing countries, Mexico, Peru, China, Australia, Chile, Bolivia, the US, Poland, Russia, continue mining. But opening new mines or expanding existing ones takes years of investment and permitting. So even if prices rise enough to justify more mining investment today, actual supply increase won't show up for a long time. This lag is why silver bulls argue today's pullback is just noise compared to a much bigger structural shortage playing out underneath. Let's zoom out and put this drop in historical perspective. Earlier this year, silver experienced a much sharper correction than now, dropping roughly 20% from its January all-time high before stabilizing. Compared to that, this current dip below $65 is relatively mild. Silver's broader year so far started around $50 at end, January correction lows, up to highs in the $85 to $89 range during spring, pulled back again, bouncing in high 60s to low 70s for weeks. Now this latest slide. That sawtooth pattern? Extremely normal for silver during a long-term bull cycle. Silver has a reputation, even among experienced stackers, for being more volatile and emotionally challenging than gold. It moves faster in both directions. That's part of the trade-off. Go back further in history? Every major silver bull market included multiple double-digit percentage corrections along the way, sometimes more than once a year, even while the overall multi-year trend kept climbing. Investors who panicked and sold during mid-cycle dips historically missed out on much larger gains afterward. That doesn't mean every dip always recovers. Nothing's guaranteed. But a 5% weekly pullback by itself isn't historically unusual or alarming within a broader bull run context. Let's lay out the actual bull case in plain terms. There's a real, credible path higher. It depends on a few things lining up. First, the Iran ceasefire needs to actually hold. If oil keeps normalizing because shipping through the Strait of Hormuz resumes and sanctions relief boosts supply, that removes one of the Fed's biggest justifications for staying tight. Lower oil means lower inflation pressure means less reason to hike. Second, Warsh's policy path needs to follow underlying inflation data rather than scary headlines. Core inflation, stripping out volatile food and energy, was running at 2.9% in May, well below the 4.2% headline inflation that includes the energy shock. If Warsh leans on that calmer core number instead of the inflated headline, much friendlier environment for silver. Third, if physical inventory stress becomes visible and undeniable, delivery delays at major vaults or visible COMEX tightness that triggers sharp, fast price spikes, Traders rush to secure physical metal before it gets scarcer. If those three things line up, some analyst projections put silver's year-end target in the $90 to $106 range. That's a serious move from the low to mid-60s today. Let's be fair about the other side. Responsible stackers need to understand downside risk as clearly as upside potential. If the ceasefire breaks down and oil re-spikes above $100, that reignites inflation fears. Combine that with a Fed under Warsh that actually follows through on a rate hike, real recipe for further downside. In that scenario, some analysts see silver retesting support in the $60 to $63 range, roughly another 15% below current prices. Worth remembering, a Reuters poll of over 100 economists found the vast majority expect no rate change at all through year's end. That's more dovish than what some loud, hawkish Fed voices suggest. Real disagreement even among professional forecasters. When experts themselves are split, that's usually a sign volatility will stick around in both directions. So what does this actually mean for you physically stacking silver? First, a pullback like this is exactly when long-term stackers historically add to positions rather than panic sell. The logic is simple. If you believe in the long-term supply deficit, industrial demand growth, and historical gold-silver ratio compression during bull markets, then short-term dips driven by Fed headlines are just noise. Second, pay attention to premiums when buying physical right now. During price weakness, premiums on coins and bars sometimes compress. You can occasionally get closer to spot than during panic buying frenzies. Worth watching if you're planning your next purchase. Third, don't put yourself in a position where a 20 or 30% drawdown forces you to sell at the worst time. Silver's volatility is a feature, not a bug. If you're stacking with money you might need in the next year or two, you're exposing yourself to stress that leads people to sell low and buy high. Opposite of what you want. Fourth, keep an eye on that gold-silver ratio. If you start seeing it compress meaningfully below 60, that's historically been a signal. Silver's entering a stronger phase relative to gold. Might be worth adjusting how aggressively you're allocating between the two metals. Finally, don't make decisions based on a single headline, whether it's a peace deal, a Fed meeting, or a scary price drop. The real picture requires looking at multiple forces together: the dollar, the Fed, geopolitics, the supply deficit, and historical correction patterns within bull markets. Anyone in isolation can be misleading. So to wrap this up, yes, silver dropped below $65 this week. Yes, it's grabbing headlines. But when you pull apart why it happened, stronger dollar, hawkish surprise from a new Fed chair, lingering inflation fears even after a ceasefire, none of that changes the underlying structural story. 6-year supply deficit, growing industrial demand from solar and electronics, gold-silver ratio with room to compress if this bull market continues. Is this the dip before the next surge? Based on everything we covered, there's a credible case for yes. But it depends heavily on whether the Iran ceasefire holds and whether Kevin Warsh leans toward the calmer core inflation data rather than panicking over the energy-driven headline number. Watch those two things closely over the coming weeks. If this breakdown helped you understand what's happening instead of just throwing scary numbers at you, hit that like button. Subscribe if you haven't already. I'm putting out fresh updates multiple times a week. Drop a comment below. Are you buying this dip or waiting to see what happens with the Fed first? I read every comment. See you in the next one.